spoke today. Now, some classes, I didn't get a chance to go through chapter review problems for Chapter 2 last session, so I'm going to be going over them briefly at the start of this class. If you've already covered that in your previous class, please feel free to skip ahead to that part of the recording. So welcome back, everyone. Let's get into it. Just a reminder to my students here, questions are always okay. Discussion should be respectful, but more importantly, please understand there's no such thing as a bad question. There may be a question that I don't have time to cover in class. You can always send it to my email address. If I get it there, I will be able to answer when I get time and give you a more thoughtful answer than I may be able to in class. But for the lecture itself, if there's anything that's unclear or you need some clarification on that, please do ask. My general rule is always, if you have a question, probably someone else in the class has a question as well, and by asking that question, you're going to help clarify it for everyone. All right. The other thing to mention here, I do respect class time, so we're going to be going from 9 to 12 this morning, and then taking a break for lunch. I do try to keep these to about 3 hours. If you have to go, if you have to do something right at the end of class or before the end of the class, please do. That is the purpose of having these recording sessions, so you shouldn't be missing very much if you need to peace out a couple minutes early. All right. So with that in mind, I also want to mention, because some students have been reporting this more in my other classes, so normally a PDF of each presentation is sent out after every class within 24 hours. This is the goal. On our weekend classes, on all day Saturday, all day Sunday, that would be out. They'll be sent out after the second class, normally in one email. But if you don't receive that within a day or two, let your instructor know in a new email. So don't just reply to a previous email. Put it in a new email. That way, the instructor will see your email coming directly from you. Microsoft Outlook has a feature, in quotation marks, where if someone replies to a mass email, then all replies will show linked together, kind of like a thread, and it's easy to miss emails when you do that. So if you've got, just in general, any questions or you're missing something, send them in a new email to the instructor and mention what session you are in. Many instructors have more than one class where they are teaching, and many of our students have similar first names, for example. So it will help save time for the instructor if they can say, this is Bill from the Thursday class, for example. The recordings that we do here are uploaded only after they are finished, usually within a day or two. In this case, we had technical issues with our recordings on Wednesday and Thursday, so hopefully third time is the charm. So don't panic if those don't go up immediately. We do always strive to get a recording up there as quickly as we can. All right, so in our previous class, we walked through the first roughly half of the tax return. We looked at step 1 of the tax return, which is only for information purposes, and then we walked through step 2, 3, and 4 of the tax return, where we looked at some simple examples of how we calculate income using examples that are related to employment income, which is the default sort of income that you will see on tax returns. So in this first part of the course, we are confining ourselves to relatively simple, straightforward examples of things related to employment income. So we looked at employment income on the T4. We looked at the kinds of employment income and benefits that you would receive that are not necessarily going to be on a T4. And we also then looked at some simple deductions that are related to employment income. And then we moved on to the chapter review problems, which we're going to quickly go over now. just for anyone who missed them. And again, students watching online who may have seen some of this before, feel free to skip ahead a bit in the recording. Now, the idea behind the chapter review problems, again, for anyone who missed it, is that we take typical examples dealing with the concepts that we've had in the chapter and in the course so far, and we pose them in such a way that we want you to get a sense of the methodology we use. When someone comes in to one of our tax offices to get their taxes done, they will come in and they will give us a bunch of information which we then have to process. So we've given you a checklist to work through to help you understand what sorts of things are going to be important. So first, you want to read the problem thoroughly and then confirm the personal information that you need to put on page 1, what is and isn't relevant, what does and doesn't need to go in, and then questions for page 2, so related to Canadian citizenship, whether they want the Elections Canada question and so on, whether they have any specified foreign property needs to be reported on a T1135, and so on, and then analyze the tax return problem itself. What information is required for the return? Is there anything that's not required for the return? You want to look closely at the T-slips, see what's on there, and then determine for this stage of the course, we're not calculating tax just yet, but determine the income that needs to be reported on the tax return and the deductions that need to be reported on the tax return. So questions that we would work through here is that, first, is there any information which doesn't belong on the tax return? What should we do with the email address? And then what amounts are entered on line 10100 and then 10400, and is there anything on line 10100? What amounts can be deducted from total income? So if you don't have the chapter review problem in front of you, let's just have a quick look back at it here. So remember, the chapter review problems come at the end of each chapter. So for chapter review problem 2-1, we were looking at Aaron Smith, who is single, lives at King Street South in York City, has no children. He works for Able Construction. His T4 is down below. He also has contributed to a wage loss replacement plan, and he also has done some odd jobs. His only other income is $5,000 from a lottery ticket, and we know that he's a Canadian citizen, but he doesn't want to provide his email address to the CRA, and he's inherited $150,000 from his Uncle Charles. Now, this is something which should immediately suggest to us that, oh, this person might have some complications from this, and indeed there are. The inheritance is not taxable, but he invested the whole amount in the purchase of a piece of land in Florida and expects it to become much more valuable in time. So notice the language here. Right? He's invested it, he has bought a piece of land, and he's hoping it goes up in value. That tells you it's an investment property. This isn't a vacation home. He's not looking to build a home there and retire. He's expecting it to increase in value. So based on this information, and we know that he put the entire $150,000 towards buying a piece of property, we know that the property cost value is at least $150,000. And we can assume it's just around $150,000 then. All right. Question over here. Okay. There we go. All right, so with that in mind, and we have a quick look at the T4. We can see from the T4, the 2400 here, down here in box 40, wage loss replacement plan benefits. They will already be included in box 14. Anything else in here that we need to pay attention to? There are union dues in box 44. So we can expect those to be a deduction. And apart from that, no other unusual boxes here. As always, we would double check to make sure that the name is correct and the social insurance number is correct, and that the client has actually brought in their own T4 slip. Now, when we fill out the return, all we asked you to do was to complete the return to the end of taxable income, line 26000, and we wanted you to enter 446.27 on line 22215. We're going to talk about that this morning in Chapter 3, what that is, where that's coming from. So for now, don't worry too much about that. When we open up his T1, and then we can just jump to that up here. Oh, yeah, it's up here. So we are only looking at the first half of it. So the personal information is up here. And let's annotate a couple of things here. And remember, students, if anything of this is unclear, you got any questions, just feel to ask. And if the key thing with these early problems is that we're not asking you to complete the entire return, just what we've talked about in class so far. So the personal information will go up here. So the city you would put in would be your city, and then the province would be BC for us, if you're in BC. Postal code should begin with a V because it's British Columbia postal code. The social insurance number and birthday should go here. Marital status should be single. Language of correspondence should be English. This section here is blank because he's been a resident all year. He didn't enter or leave Canada. And province or territory of residence is British Columbia. There's nothing to indicate that it has changed since then. All right. Notice that there is no spousal information. He is single. Now, we will deal in the course later on with the situation which happens when someone is single for only part of the year, so their marital status changes. But for now, we're only going to be looking at simple examples where the status is the same through the year. For the Elections Canada question, he is a Canadian citizen, but he doesn't want the CRA to give his address information to Elections Canada to update the list. There can be a variety of reasons for this. Some people may want to keep tight control of that information and only deal with Elections Canada directly. Some people may know that they are about to move, so the address on the tax return is not going to match where they will be living when an election happens, and so on. So there's nothing to indicate that he would be a First Nations person with status under the Indian Act, so that can be left blank. And, whoops, there's nothing in the problem to indicate that he wants to register for the British Columbia, would like more information about organ donation, which again applies in some provinces. So in BC, this is simply authorizing the CRA to give your contact information to BC Transplant so they can send you more information. Just like with Elections Canada, it's just to update a mailing list essentially and to let them know you'd like some more information. Again, this can be a sensitive topic for many clients, so we should handle it with discretion, but it's simply requesting if someone would like more information about it. The main thing to note is that Aaron does have specified foreign property, so we're going to indicate yes there, and we will be looking at his T1135. All right, getting on to the main part of the return itself. The employment income, box 10100, remember that is taken from box 14 of the T4 slip. In this particular case, though, some of the amount in box 14 it was from a wage loss replacement plan, and that amount was reported in box 40 on the T4. So remember, if the wage loss replacement plan benefits are on the T4 themselves, this means the employer controlled the plan, and this means that some of the money which went into the plan can come from the employee and some from the employer. From the information given in the problem, we know that $1,200 of those benefits are actually Charles's own money, which he's put into the plan. So that's not new money, that's not income. Therefore, that $1,200 is deducted from the box 14 number to give us a lower number on line 10100. Right? So, in other words, if the CRA is looking at this problem, if they're looking at his tax return later and they say, wait a minute, this person has $48,127 in box 14 in income, but this amount on line 101 doesn't match that. For the CRA's purposes, then, they will be able to say, there's an amount on line 10130. So line 10130 plus line 10100 equals box 14. Then the CRA says, we understand what's happened here. They might ask to see more documentation, but they will understand what has happened. That's the purpose of in general, these informational lines here are to tell the CRA that something is going on. Now, other employment income on line 10400, normally that will be tips or odd jobs. In this case, with Aaron, it is odd jobs. It is added together with line 10100. Notice, again, all the little plus signs down here to indicate we're going to add these figures together in a column. So his line 23 number is 47,227. And that carries down all the way to the bottom page. So his total income is 47,227. And Marlise is asking, do we subtract all these amounts from line 10100? It depends on what they are, not always. So you don't do it on this form is a key point. Right? You simply manually, outside the form, say, this needs, he's already contributed $1,200, so we can reduce this amount by $1,200. For the emergency services volunteers, we'll talk more about that a little bit, but that amount is in box 87, I think. That amount is not automatically added to box 14, but you must include it here if you are not treating it as income. Right? So it doesn't need to be subtracted. It needs to be added if you're not putting it there. So it's a little different. And commissions, these are already included in box 14. These simply tell the government that this is a commission sales employee, and this means that employee can claim more things for employment expenses. So that truly is just an information-only field, but it tells the government that this is an employee in a different class of employment, essentially. So each of these fields is handled slightly differently. What they all have in common is that they're not added directly. There's no plus side or subtraction with these fields. Okay? Good question, Lance. So, the total income. Divya, their information purposes, they are not added or subtracted directly. Some of the fields you will notice do have plus signs and minus signs here further down the page. So, but the key point is they're not added or subtracted directly. Most of them are for information purposes. A few of the more complex ones that are beyond the scope of this course you do some math over to the side, but they're not directly added into this column from a mechanical point of view. All right, so speaking of mechanical points of view, the total income here travels down to the top of the next page. And then we add up all the deductions over here in this column that are going to be deducted, that is subtracted, to produce our net income. Now, in this case, again, we see the same pattern. Things are added, the deductions are added together in this column, and things that are more for information purposes are off to the left. Now, in this case, we don't have anything like that, but we will in the next problem. So here we have the union dues from box 44 of $685, and the amount that we gave you in the problem for line 22215, $446.27. Again, we're going to talk about that a little later on this morning, what that is, where that comes from. The total deductions there are $1,131.27, giving us a net income before adjustments of $46,095.73. Now, if he was repaying EI or old age security, something more would be deducted. In this problem, that doesn't apply. So the net income then is $46,095.73, and that carries forward to the top of the following page down here. And if there were deductions from that to give a lower taxable income, those would show up here. There are not, so the taxable income is just $46,095.73. And that is as far as we asked you to go with this problem for today. Now, if you like, a good thing to do is to hang on to this, and then as we get further in the course, you can continue to fill out this problem. After today, for example, you'll know how to calculate tax on taxable income and work your way further down the problem. We're not going to talk about provincial taxes until next week, for example, so those are kind of necessary to finish it off and give you a final result. But if you save this for now, you'll be able to work on it as kind of an extra practice as we go forward. The one other thing I want to show you with Aaron is this T1135. Now, the T1135, a few things which we didn't get a chance to talk about much in class, but are clear once you do the form. Now, you'll notice at the top, you could put amounts in foreign currency. It's not obvious from this, although it is in the instructions for the form. That option is only available to taxpayers who are not individuals. Notice this form also can be used by corporations, trusts, or partnerships. For individuals, everything has to be done in Canadian dollars. So you fill in one line here, so Aaron Smith, and then his social insurance number. The individual code is 2. 1 only applies if you or your spouse is self-employed, which doesn't apply here. Aaron's address would go down here, and you indicate the taxation year that this form applies to. A reminder, the T1135 is not a tax return. It is an information return. It is filed independently of the tax return. Now, a key question here is how much property is involved? If the total cost of all foreign property, specified foreign property held during the year is less than $250,000, you can use the simplified method in Part A. And it's quite simple. You simply indicate what types of property you hold. In this case, it would be real property, real estate, or you could call it other property. So just tick the box or boxes that describe the property, and then name the countries where the property is held. In this case, it's just one property, USA. If there's more than one property, you list the top. More than one country, you list the most important 3. You indicate if there's any gross income from the property or if the property was sold. In this case, there's no income, nothing to sell. This is all you have to do. Tick one box, write in USA. So not so scary. The scary part is you have to file this form or you'll be penalized. Now, if you look further into the form, you can see that the form can get more complex if you have other kinds of investment. If you've got a combination of funds, shares, interest, real property, and so on. And in those cases, more information is required and you have to specify it. The simplified version, most valuable, right? What is the specific wording they use here? Top 3 based on the maximum cost amount, right? Okay, there is some crinkling in the background. That's not me. Can you hold me okay? Hear me okay? All right. That's actually not static you're hearing in the background, but you can hear me okay. That's the main thing. All right. All right. The key thing to put at the end is the certification. So Aaron needs to put his name and sign it here. Position and title is going to apply. Remember, this form can also be filled out by people representing partnerships, trusts, and corporations. And notice that the tax preparer information goes over here. So in this case, it's H&R Block Canada, and our office address would be Calvin in this case, with our telephone number there. The voice is still a bit choppy, eh? Okay. I can try switching to a different router. We'll see how that goes. But first, that'll just take me 1 second here. We'll have a look at chapter review problem 2-2 now. Charles, just pause the recording, will you?
Okay, I'm pausing the recording.
There we go. Okay, so, all right, now someone had a question about check 1 or check 2 in the beginning of the form. No, that's not the individual versus corporate part. I might as well show you this. If you look for something in the CRA, and I think in the fillable form you have down here, if you look at the full version of the form, it will have instructions for it. So almost all the forms we look at, although we have provided them to you in the fillable form zip file, you can also download them directly from the CRA, and I find that a little faster sometimes. One thing to be aware of with the T1135 is there is a full set of instructions on it. And often it can be faster to simply look at the instructions for some basic information. In this case, so for the individual code 1 or 2, this simply indicates whether the individual or their spouse is self-employed. So in this case, 2 just means they're not self-employed, right? So it doesn't need to indicate if they are individuals, trusts, corporations. That is a separate box, okay? All right, so yeah, just as a general note, I mentioned that if you're having trouble with the form, often some forms have a lot of instructions attached to them. Now, you guys aren't going to need the instructions so much because you have me, but in general, if you're looking at a form and you're having trouble with it and I'm not around, often the forms will have instructions available either as part of the form itself or elsewhere on the CRA that you can also access. Now, for chapter review problem 2-2, this was a little simpler. There was no T1135 involved. This was for Serge Caron-Boileau, who lives on River Road in York City. And for Serge, he is married to Jamie, and Jamie's net income was $30,000. He wants to register for online mail with the CRA, and he's a hairdresser and cosmetologist at Exclusive Salon, where he received $12,500 in tips. And for anyone who hasn't noticed it before, you can highlight things in Inkling using right-click and then highlight for your own notes. His other income is $1,200 from bingo, and then we have his T1 here. Now, there's no union dues with this T1, but he has contributed to a pension plan down here, so we'll want to keep an eye on that. Oh, and the box 42 amount. So the box 42 indicates he's a commission sales employee, which has no direct effect on the tax return. But if he were claiming employment expenses, he would have access to, he would be able to claim more expenses. All right, so let's look at his return. So for 2-2 should be the drop-down window from WebEx gets in my way in an annoying fashion. Should be right. There we go. Perfect. All right, so for Serge, let's go over his. So Serge, the main thing to note here is that he is married, so his marital status will indicate up here. Otherwise, all fairly straightforward. Sorry, Charles, you heard me okay? Okay, good.
Yes, I hear everything. I'm just answering a question. Yes, it's all good. Thank you.
Oh, no worries. Yeah. All right. I'm just a little paranoid. I did lose 2 recordings this week, so I want to make sure everything's fine. Okay, so notice that we put Jamie's information down here, and also notice how little information needs to actually be put here. All that is required is the first name, social insurance number, if we have it, if they have one, and their net income from line 23600 of the return. And that's it. Again, just to remind everybody, the spousal information we put here does not constitute filing their taxes. They can file their taxes at a later time or even not file taxes at all. The key thing is, the phrasing here, the amount it would be if they filed a return. So, which means you can put an estimate here if you don't have that information. It's perfectly fine. All right, working down return. So, yes to the Canadian citizenship question, and yes to giving that his address information to Elections Canada. No to the foreign property question, and of course, there's nothing to indicate that this person is First Nations, working on a reserve, or wants information from BC Transplant. All right, here, the employment income from box 14 is entered in line 10100. Commissions are not deducted from that. They are just for information purposes for the government. Notice that the tips income is included here on line 10400, 12,500, and is simply added in, giving a total income of 44,259.12. And again, that carries forward to the top of the next page, like that, where we have an amount which is going to be deducted for the pension plan at work, and an amount reported from box 52. So remember, the box 52 is the employer contribution plus the employee contribution. Only the employee contribution can be deducted because that is the employee's money which was deducted at source and therefore should not be considered income at this time. So that amount from box 20 is going to be deducted. Philosophically, it will be taxed in the future when Serge receives money from the pension plan. So that's what's happening here. That money is kind of put aside to be taxed in the future, is essentially what's happening there. So it is deducted for now. And then the 22215 amount is entered down here on line about 50, that's added together. The total, 1782.59, is deducted to give us the net income before adjustments, 42,476.53. And that again carries forward to the top of the next page. Oh, let's get back here. Top of the next page. There we go. Just want to show it all on the same screen. So that carries forward to the top of the next page. There are no deductions. So the net income amount is going to be the same as the taxable income amount, and in this case, 42,476.53. So that is, again, as far as we asked you to go with this problem at this time. As we get further into the course, you can continue with this problem and see where it eventually goes. All right. So in terms of the two problems, we also, when we work through these tax returns, we encourage you to think about questions. So in this case, for Aaron, if he asks why he should report the odd jobs, we would assure him that you do always need to report any odd jobs or income like that, even if it's not on a T4 slip, because we have a self-assessment system of reporting income. In the case of Serge, again, the tips have to be included in income because they are money he received from work. If his salon was audited by the CRA, for example, or the CRA audited him for other reasons, he would run into trouble if he had not reported them. Would we expect him to owe money? Probably, unless he had money taken off at source for his tips, he's probably going to owe the tax on those tips, whatever that works out to be. And if he wants to know why a spouse's information was required, well, I mean, does anyone remember why we have to include spouse's information on the receipt, on the return? Why do you think we need to report our spouse's income or an estimate of it on the return? It will give family income for child benefits, a potential spousal credit. Right, there's a variety of credits. In this case, the most applicable one, I think, is the GST rebate, where family income is considered. So let's take an example. Let's say Serge had zero income, but his spouse had a really high income, then Serge would not be eligible to receive the GST rebate. Right? So in order to claim credits of those types, then we have to include the spousal income. Otherwise, the CRA doesn't have enough information to perform the calculations. All right, good stuff, everyone. All right, let's move on to our new material for today. So for today, we're going to be talking about other deductions from your paycheck at source, such as contributions to the Canada Pension Plan and premiums for the employment insurance, both of which are broadly described as payroll taxes in various places. So if you hear about payroll taxes, they usually refer to CPP, EI. These are mandatory deductions that are not specifically for tax. We're also going to talk about some tax credits related to employment, the Canada Employment Amount, the emergency volunteer amounts for volunteer firefighters and search and rescue volunteers, and we're going to talk about a credit for school teachers, basically, the eligible educator school supply tax credit. All right. Oh, and a question. Harmandeep is asking, if tips don't show on a T4, how does a person calculate it correctly? We mentioned this in the last class, but it's important to stress again The CRA expects that someone who is receiving tips keeps a logbook of their tips, keeps their own records of their tips, showing how much they received and what day. If a logbook is not kept, if records is not kept, then the CRA can arbitrarily assess how much they think you received in tips, and then it is up to the taxpayer to disprove it, which is very difficult without records or a logbook. So bear in mind, of course, that for some restaurants, tips may already be included in the T4, so we do need to ask people when we're doing their taxes what their tip situation is. Were they getting tips? Were they included in the T4? And so on. All right. Again, the agenda, which we just looked at, is is sort of a broad overview. The specific objectives can be boiled down a little more finely. So by the end of this morning, you should be able to calculate an employee's required CPP contribution and EI premium, as well as figure out if there is any overpayment. Now, as well, you're gonna understand these various tax credits, the Canada Employment amount, the emergency volunteer amounts, and the eligible educator school supply tax credit. But the bulk of our time, we're going to be looking at CPP and EI. All right, now let's make sure everyone's awake by beginning with a simple poll question. All right, so make sure I'm pulling up the right poll question here. All right, let's and make sure I've got the time limit set to just 1 minute, because we don't need 5 minutes. Okay, so true or false, there is a difference between a deduction and a credit on the income tax and benefit return. What do you think? Okay. Good, lots of answers. This is not the trickiest question ever. Of course, at any given minute, I assume some people are always going to be away from keyboard or getting a glass of water or something like that. So if a few people don't answer, it's not the end of the world, but okay, we still have another 20 seconds left. Okay, Jan, are you seeing the poll now? Okay, good. All right, we've gone through. So, of the people who were able to respond, 100% of you said true, and 5 people didn't answer. And again, they might be away from the keyboard or getting a glass of water or have you, so that's fine. The answer is true. Okay, so with that in mind, let me ask you this. Have you read Chapter 3? Now, you've had a week, so I expect most of you had a chance to read Chapter 3. Is there anyone who didn't read Chapter 3, or at least have a look at it? For some of my sessions, I have class on Tuesday and then class on Thursday, so if there's only a day between classes, it's entirely reasonable that someone might not have a chance to read the whole chapter. Okay, so a few people haven't had a chance to look at it. All right, so for people who have read the chapter only, all right, what is the difference between a deduction and a credit? So for people who've read Chapter 3, I'd like you to try to explain this for the people who haven't had a chance yet. Good. Excellent. Excellent. You're all getting the general idea. The basic difference when we're talking about a deduction as reported on the return and a credit is that a deduction reduces taxable income. A credit, on the other hand, reduces or cancels out tax. And that can have important implications, as we're going to see. So both things are good. Deductions and credits are good, but they work differently in a mechanical sense. And so understanding this distinction as we go forward is going to be very forward in the course, because we're going to be looking at things today, particularly the Canada Pension Plan, which produces both a deduction and a credit. So understanding how those differ is going to be important. All right, let's give you an overview of what the Canada Pension Plan is, or rather, when it applies. So the Canada Pension Plan is funded by deductions from employment income, and then it's paid out later in life, generally. We're going to talk about those payouts, that income from Canada Pension Plan, later in the course. Not too much later, but not today. Today, we're just looking at the part where there is withholding tax. In other words, it's withheld from source from employee paychecks. So the first requirement is that the income is pensionable. So not everything you earn in a job is necessarily going to be pensionable. So the employee's age has to be between 18 and 70. The earnings from employment that are pensionable, there are restrictions on it. So, for example, your first $3,500 is called a basic exemption. Your first $3,500 in employment income in a year, you don't have to pay pension contributions on. There's also a maximum amount. The max is calculated in two different stages, referred to as CPP1 and CPP2. So CPP1 is the basic Canada Pension Plan earnings, and the maximum there is $68,500. So your first $68,500 of employment earnings are assessed for Canada Pension Plan contributions at one rate. Your second stage, CPP2, is on earnings up to $73,200. So there's a second tier, essentially, of earnings on the amount between $68,500 and $73,200, and that's referred to as CPP2. We'll have more information on that in a slide or two. We're going to be going through all of this in more detail. Now, box 16 then refers to the maximum pensionable earnings in a year. So this is normally going to be the same amount as in box 14. Box 26, box 16 is what's been withheld, and box 26 is the earnings. Now, in cases where someone only has to pay Canada Pension Plan contributions through part of the year, then the maximum earnings amount and the basic exemption and the basic amount may need to be prorated, as we're going to see. Now let's dive in a bit more detail. So first, let's talk about the boxes. So on the T4, box 26 is your pensionable earnings, and the amount which is deducted, the contributions which are made based on these pensionable earnings, is reported in box 16. Your basic exemption is $3,500, So box 26 can be as high as 68,500. From those earnings, we subtract 3,500, and 5.95% of that amount shows up in box 16. Now, box 26 is usually the same amount as box 14. If your box 14 is higher than this maximum, then it can be higher, of course. Box 26 can also be lower because there's an amount in box 40, because in general, most taxable benefits are not pensionable. They are taxable, but not pensionable. So that will also often explain the difference between box 26 and box 14. If box 26 is blank, you can consider the amount to be the same as box 14, unless there is an exemption here. So if there is no X in this box and this amount is blank, you can assume it is the same as box 14. Now, stop annotating. There we go. Starting in 2024, a second tier of CPP contributions was brought in. So for any income above 68,500 up to 73,200, that additional income is reported will result in an additional amount of contributions in box 16A. So 4% on this amount between 68,500. Now that is not 4% plus 5.95%. It is 4% instead of 4.95%. The main thing to be aware is that the box 26 is not split into two amounts. It is simply the contributions calculated on box 26 are split across these two boxes if box 26 is between 68,500 and 73,200. To sum it all up then, box 16 has the contributions that are withheld on the basic pensionable earnings. If someone has income over that 68,500 threshold, there will be an amount in box 16A for the CPP second contributions that are withheld. And box 28 indicates if someone is exempt from paying CPP. Now, you'll notice a slash here for QPP. The Quebec pension plan is the equivalent plan of the CPP for workers in Quebec. In general, it follows the same rules and is treated the same way as the Canada pension plan. It is simply administered provincially. So from a tax point of view, QPP and CPP is functionally identical. It's simply based on whether the employer is based in Quebec or not. You'll notice, if you back at the form, there is a parallel set of boxes for Quebec pension plan, so box 17 and 17A. So if the province of employment is Quebec, you would expect to see the amount in 17A instead of 16 or 16A. Otherwise, all other things we're going to be talking about today apply equally to CPP and QPP. And that can be important for cases where someone works in Quebec for part of the year, but is a resident of a different province at the end of the year. Then their Quebec pension plan contributions are going to be considered for when you're calculating their tax. Now, what we mentioned earlier that the basic contribution on that first 68,500 is 5.95%. So, breaking it down for 2024, your maximum pensionable earnings 68,500. the first 3,500 is exempt. So this means that the maximum earnings subject to the contribution are 65,000. So 5.95% of 65,000 is 3,867.50. And if we split this apart, 4.95% of that is 32,1750. 1% of that, so very easy, 1% of 65,000 is 650. And we refer to these as the base contribution and the enhanced contribution. All right. Any questions so far? Are you with me so far? Good. Okay, so yeah, Canada Pension Plan is one of those things that has several moving parts. So I just want to be very clear about all of them so as not to overwhelm anybody. Now, the reason there's this distinction between base contribution and enhanced contribution is that the base contribution is going to be used as a tax credit, whereas the enhanced contribution is going to be used as a deduction. So that's why this division is important. It's all in Chapter 3. It's all in Chapter 3. All right, so just to make sure everyone's feeling good with how this works out mechanically, we're going to look at a simple example. So we're going to calculate the CPP contribution for an employee with pensionable earnings of $43,500. So to calculate their contribution calculation, we take their pensionable earnings, deduct the basic exemption, and obviously 43,500 minus 3,500 is going to give you 40,000. All right. So 40,000 times 4.95%, 40,000 times 1%. So 40,000 times 4.95% is 1,980, and 40,000 times 1%, of course, is 400. So the total contribution for the year is going to be 2,380. That will be the amount that appears in box 16. But on the tax return, we use these component numbers. So, continuing then, for an employee with pensionable earnings of $43,500, their total contributions of $2,380 appear in box 16. The $1,980, the 4.95% of the 40,000, that's a non-refundable tax credit and is reported on line 30800. The 400, that is 1% of the 40,000, that's a deduction and goes on line 22215. So in the chapter review problems we looked at last chapter, that's where this line 22215 comes from. It is 1% of the person's CPP pensionable earnings over 3,500. Now, Divya has a question. What is 3500? Oh, the 3,500? Yep, no, that's a fair question. I'm with you. So let's go back. Click, 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 click. The 3,500 is a basic exemption. So you are, I've lost my cursor. There it is. All right. So basic exemption means that if your employment income for the year, not per job, none of these amounts are per job, they are per year. So if your employment income for the year is less than $3,500, you do not have to contribute to the Canada Pension Plan. So that's where the $3,500 comes from. This can be important if someone has a lot of money from odd jobs or casual labor, for instance, because if you have odd jobs or casual labor for the year, which are more than $3,500, then you'll have to treat it as self-employment income because then you need to contribute to the Canada Pension Plan. So this exemption number is actually quite important. Now, one thing I want to mention, and I think this might be as good a time as any, is that the Canada Pension Plan contributions have changed a bit over time. The rates I'm quoting to you today, the 4.95% and the 1%, will be different if you go back and do a tax return from previous years. So, for example, the enhanced contribution amount was introduced in 2019. Prior to that, you only had to pay the basic contribution and claim it as a refundable, non-refundable tax credit. In order to enhance the contributions to the Canada Pension Plan, make it a little bit more financially solid, this enhanced contribution was brought in, but to help ease the sting of that, it was made into a deduction, which tends to be more beneficial from a tax point of view for people. So again, that changed in 2019. Also, the rates for given years, you go back and look at past years, you can see what the rates were in past years. And what you can see for CPP, if you go back several years, and this is from the CRA site, by the way. If you Google CRA contribution rates, they have all the information there, and you can go look at the information for CPP and EI. This is mainly aimed at employers, but we can find it useful too. What you can see is that 4.95% basic contribution rate, that has been stable for a very long time, right? It's only in 2019 that this enhanced contribution rate came in, and subsequent increases have only been to the enhanced contribution rate. And currently, that's stable at 1%, which is easy to calculate. When it first came in 2019, it was only an additional 0.25%, which was more of a pain to calculate. What you will also see here is that the maximum earnings subject to CPP are indexed for inflation and have gone up. They have gone up quite a bit with the spike in inflation after COVID. So since 2020, they've gone up by about $12,000, whereas before that they were going at half that rate, purely due to inflation. Other things you will note here: the basic exemption amount is not indexed for inflation, and it has stayed stable over this entire time. Okay, so that chart I'll keep open in a tab in the background in case you need to go back and have a look at it. But it can be useful to understand where some of these things come from. Now, an additional component was brought in to strengthen the CPP in 2024. And that was an additional contribution on an additional tier of income. So new for 2024, earnings over the previous maximum, the basic maximum of $68,500, up to $73,200 are subject to an additional, are subject to 4% CPP withholding. So this means that the maximum earnings subject to this 4% are $4,700. And this additional contribution, again, is treated as a deduction. It is directly added to the amount on line 22215. And this maximum additional contribution for 2024 is 4% of $4,700 or $188. Again, this was brought in to strengthen the CPP. It does not apply to years prior to 2024. We refer to it as CPP2. I don't think CRA is really settled on a good descriptor for it just yet. For now, CPP2 is what we are referring to it as. I've also seen it referred to as second CPP or what have you. But essentially, it's analogous to a tax bracket. It's a second level of income, but the tax is not cumulative. So you're not paying 5.95% plus 4%. You're paying 4% instead of that. And again, this is to reflect that people's incomes have gone up, and people in higher tax brackets will also want to collect CPP, and so CPP should be collecting from a higher portion of income. So, to show you how this works in practice, we're going to calculate the CPP contribution for an employee with pensionable earnings of $73,200. So in this case, we take the pensionable earnings of $68,500 minus the basic exemption of $3,500 at 4.95%. As well, the pensionable earnings of $68,500 minus $3,500 times 1%. So in other words, $65,000, 1% of $65,000, 4.95% of $65,000, plus the pensionable earnings of $4,700 plus 4%. So line 30800 will be $3,217.50, like we saw previously, but line 22215 will be $650. Again, that's 1% of $65,000 plus the $188 for $838. Okay, so a lot of little components here, all of which are individually fairly straightforward, but it can be a lot to kind of absorb. So, but if we think through it logically, break it down step by step, none of it is too difficult. Now, these maximum amounts here, you may have noticed, also appear on the CPP contributions rate page. So if someone is at that maximum, then that $3867.50 shows up here, and this is for the basic vegetable earnings amount, not that higher tier. So you can also find these numbers online with the CRA if you need to pull them up quickly. Now, question. Oh, that's a good question. That's a good question. Okay, which question? So does the limit change every year? So as we can see from that chart, the maximum earnings do change every year, at least potentially. Good question, Srihari. And Jahan asked, you can use 5.95% if you want to calculate the box 16 amount. But to break it apart into the credit and the deduction, you need to do the 4.95% plus the 1%. And Jan, normally everyone pays both RPP and CPP. Well, not everyone has a registered pension plan through work. I think that's an important thing to understand. Some employers just don't have a company pension plan, so they won't have RPP, which is part of why the Canada Pension Plan exists. It is to ensure that everyone has at least some sort of pension when they retire. And how do you calculate the $650? Okay, yeah, so let's have a look at that. So remember, the $650 is on the CPP one. So let's assume that someone had, say, so remember, if it's the maximum, then we can easily figure out everything because we already know, it's maximum. I can just look that up. I don't even need to do the calculation. So 68,500 minus 3,500 leaves us 65,000. 1% of 65,000 is 650. And 4.95% of 65,000 is 32,1750. All right. And Jan, I think a better way to think of it, Jan, is that RPP is a private pension plan, typically through someone's employer. And a CPP is done through the government. So CPP is based on how much you earn. For RPP, they could be based on how much you earn, but it depends on the arrangement between the employer and the plan and the employee. Okay, lots of good questions here. And if someone moved from Quebec halfway through the year and was paying into the QPP, how would that affect if you have to calculate CPP, or would it not have anything to do with it? The end result would be the same, but there is a special form that is used to calculate the combined amounts for CPP, QPP. So, and we're not going to touch on that in this course because that gets a bit more complicated. But essentially, instead of a Schedule 8, they use a different form, which is beyond the scope of this course, but it gives the same result. We'll do the short version. Okay. And okay, all right. So it sounds like everyone's doing okay. Good, good, good. And what's our timeline? Oh, okay, not too bad.
Just a little comment here. Is it?
Yes, Charles.
Srihari is asking about, can we just use the total contribution rate instead of the 4.95% and 1% separately?
Yeah, and yeah, I did touch on that. The total contribution rate is useful if you just want to calculate the box 16. But if to break box 16 apart into the non-refundable tax credit and the deduction, then you have to do the 4.95% and the 1%.
Perfect.
So, yeah, so understanding where that box 16 comes from and how it's calculated, then we know how we can break it apart. All right, and I can see we're not too far away from our break slide, so let's just keep going. Right, so now, good, we're getting into a question stage. So we've talked about required CPP contributions. Oh, Srihari, do you still have questions? Charles, maybe check in with Srihari while I keep going. Oh, the contribution rate. So the contribution rate is set by the CRA, and that varies from year to year. So in any given year, the contribution rate is going to be set by the CRA. And so part of the contribution is on the basic, Part of the rate is for the basic contribution, and part of it is for the enhanced contribution. Okay, so moving on. If the amount withheld is more or less than what is required, what do you think happens? Yeah, so there would be an overpayment or an underpayment. How do you think that's handled? Okay. Good, good. I think most of you have the idea. Very good, very good. Okay, uh, if you contributed less than what's required, you report what was withheld, um, and if you've contributed more than what was required, you only need to report what is required. So it's the difference we're concerned about. So here's the key points. There is no penalty if there's an underpayment. The taxpayer is not required to pay the difference. So there's no penalty here. It may, however, impact how much CPP they receive down the road if it's a significant underpayment. So the taxpayer does have an option to voluntarily make up those contributions using a form called a CPT 20, which we're going to touch on a little later. In the case of an overpayment, any overpayment is refunded by the CRA, and the overpayment is claimed as a tax credit, a refundable tax credit, on line 44800. Now, so let's break it down again. So the required premium then is calculated, and it's compared to the actual Box 16 amount, and 16A if applicable. So a common reason for an overpayment is if someone works more than one job in the year, or it may be a simple payroll error. Again, it's important to understand that the exemptions and maximums are per year, not per job. So if you have more than one employer, the employers cannot take each other into account. So they will all just deduct CPP, and it's under those circumstances easy to overpay for CPP. So we're going to go through several examples of over and underpayments to make sure everyone's solid with the concepts. CPP overpayments will come up in later chapter view problems, so they're a constant possibility. A key point is that employers sometimes make errors, and of course with multiple employers there's always this possibility. Yeah, if we have time later on, I can go through in a bit more detail what we have, but let's look at some basic examples for now. So what I'd like you to do, knowing what you know now, we're going to look at someone's CPP. So here's a taxpayer, their Box 26 amount is $12,000, and their Box 16 amount is $499. So is that an overpayment or an underpayment? And if you all have real trouble, I'll pull out my own calculator, but all right. So assuming it is an underpayment, How much is it an underpayment by? Oh, I'm seeing some different results here. Okay, let me get out the old calculator and whoops, get back to so clear that. So let's say with a box 26 of 12,000, first thing we do, we deduct our exemption. So the first 3,500 is not subject to CPP, so we just deduct that. So there's going to be $8,500 subject to CPP. Then we multiply that by 0.0595, that is 5.95%. That gives us 505.75. So that's the required amount. As we can see, that's more than box 16, so this was an underpayment. We deduct the 499, and that gives us $6.75. So it's an underpayment for $6.75. Okay? So when people run into have trouble with this one, normally it's because people forget about the exemption. It's very easy to forget about the exemption when you're doing these calculations. But if you've got the exemption right, it's not too bad. All right, for our next example then, I would like you to look at one where it's 0.5, the 0.0595, that is just 5.95%. Right? So remember, that is 4.95% for the basic contribution, which becomes the tax credit, and 1% for the enhanced contribution, which becomes the deduction. Okay, so let's look at a box 16 of 25,000 and a box 26 of 25,000 and a box 16 of 1,316. Is this an overpayment or an underpayment? Okay. All right. Most of you are correctly identifying it as an overpayment and an overpayment of $36.75. So again, let's just walk through for practice. So 25,000 in earnings, we deduct our basic exemption of 3,500. That gives us 21,500 times 5.95%, 1279.25. So we can see that is less than the box 16 amount. So this is an overpayment of $36.75, and that overpayment will become a refundable tax credit, about which we will I'll be showing you more later mechanically where that comes in. All right, so let's discuss that. All right. Yeah, I just find if I have the calculator on screen, it's just clearer overall. All right, now we've talked about pensionable earnings, but it's good to take a moment and just clarify what kinds of employment earnings wouldn't be pensionable, because they're not always pensionable. Now, some people are simply exempt entirely. So what might produce that exemption? So first of all, wages that are received when you are either too young or too old to be subject to the CPP. So wages received before and during the month of your 18th birthday, you are exempt from. So if you're a teenager working in high school, you don't have to contribute to the CPP. wages received in any month after the 70th birthday. So once you are 70, you are assumed to be collecting CPP for sure, so you no longer have to contribute to the CPP. Wages received by someone aged 65 to 70 who has filed a CPT 30 election. So once you turn 65, you can send in a form to opt out of the CPP. That's called a CPT 30. And any months in which you receive CPP disability, you are drawing from CPP, so you can't contribute to CPP while that is happening. And of course, there's specific employment which is not directly subject to the CPP. For example, tips income. You can opt to contribute to the CPP, but you don't have to. It's not required. Good question, Isabel. Can you opt into CPP before the age of 18? No, there is not at this time. I think that has to do more with mechanics than anything. And also the number of people working before the age of 18 is relatively low. But I assume there are, I suspect it's got to do with issues of administrative convenience and maybe statute as well. Bear in mind, the government wants to encourage people to stay in school and finish high school. So that, I think, is part of it. The government does not want to encourage teenagers to join the workforce. And also, teenagers at that age should be living at home and being supported by other people. So we're going to see another couple examples of this where people under 18 are a little restricted in what they can do, and it's usually some combination of those things. If tips are higher than 3,500, no, they're not. Tips specifically are not subject to benchable earnings unless you choose them. Good question, Harmon. Can you withdraw from the CPP other than in retirement? We'll talk about that more when we get to CPP benefits. Normally, it's not voluntary, but there are a couple cases, and we'll talk about those in a future session, but it's not voluntary. If someone is leaving the country, no. Okay, let me give you the really brief version of this. When someone leaves Canada, they do not receive their CPP immediately. They can apply for CPP when they reach the appropriate age, even if they are no longer living in Canada. Other countries do this differently, would be the short version. Canada has a variety of agreements with other countries called Social Security compacts, and depending on the specific terms of the compact, in general, if you were in Canada some years and then worked in another country for some years, you may qualify for a Social Security pension like CPP in both countries, or in just one country, just in Canada, or just in the other country. In general, there's usually some sort of mechanism to allow your CPP contributions in Canada to be applied towards your Social Security pension in the other country. Yeah, but in general, if you leave Canada, you can still receive CPP benefits when they reach retirement age. Thank you, Charles. All right, but it really does depend on the specifics of the case and the specifics of the country. Now, one last thing before the break. Retirement age is 65 to 70, as we're going to see. Proration is required when someone turns 18 during the year or turns 70 during the year, or they're between 65 and 70 years of age and they are receiving retirement benefits, but they want to stop making CPP contributions, so they file an election, or someone is drawing CPP disability benefits for part of the year, or someone dies before the end of the year. So in all of these cases, we need to use a mechanism called proration. There's a chart in the Schedule 8, which is easy to find because it's in the Schedule 8. So if someone's subject to CPP for the full year, for 12 months, then we use the normal maximums that we've talked about before. There are additional maximum pensionable earnings, $73,200. Their basic maximum pensionable earnings, $68,500. The basic exemption is $3,500. And so the difference between CPP 1 and CPP 2 is an additional $4,700. If someone is only subject to it for 1 month of the year, then you get 1/12 of that. So if someone turns 18 in November and they only have to pay CPP for 1 month, then the additional maximum earnings are $6,100 or $57,0833. Their exemption is $291.67, and so the difference between CPP 1 and CPP 2 for them is $391.67. If the number of months is between 1 and 12, again, this is 1/12, so this is 2/12, this is 3/12, 4/12, and so on. You can see this is proration. We simply calculate what portion of the year someone is subject to it and then modify these amounts accordingly. Now, this chart is directly from Schedule 8. There is also a chart in our reference guide, where that is here. In our facts and figures guide, so there's a chart which divides it up by which month a specific condition applies. So use column 1 if someone, for example, turned 18 in the month, they stopped receiving disability benefits in the month, or they revoke an election made in the prior year. So depending on, and column 3 if they begin to receive disability benefits in a month, column 2 if they died in the month, and so on. So depending on the condition that applies, then you simply use this chart and then read across. So if something happens, so for example, if someone turns 18 in August, then their maximum earnings they'll be assessed on is $22,833.33, and for the second tier, $24,400, and the other amounts are going to be prorated accordingly. It's important to note that the second tier of CPP, CPP 2, was only brought in 2024. So prior to that, the chart for proration was a little easier to read. So I kind of prefer previous year versions of the chart because they were a little simpler to read. The current year has gotten, we've needed to compress it a bit to accommodate CPP 2. But that's a general idea. All right, almost to our break, so just to review real quickly. So CPP elections that I've talked about previous. So a CPP 20, that's a form you use when you want to pay contributions that you're not required to. And the CPT 30 is when you hit 65, you can opt to stop paying into the CPP. Now, a good way to remember the difference between these two is that the CPP 20 is generally going to apply when you're younger, so that's a smaller number, And the CPT 30 is going to apply when you're older, so that's a bigger number. And again, election here simply means choice. If you're unfamiliar with this use of the term, to elect is to make a choice. So this is what happens when we have an election to choose a government. We are making a choice. So in tax terms, an election is something which is purely optional, which is decided by the taxpayer's choice. So you, the taxpayer, can choose to pay contributions on your tips, say, or you can choose to stop contributing to the CPP once you hit age 65. An election is typically just sent, it's a simple form or simple statement that you send to the CPP saying, yes, I am making this choice. Right. So on Schedule 8 is where we calculate CPP contributions, any underpayment or overpayment, and it also contains that proration chart that we saw previously. It also handles CPP contributions for self-employed individuals, but that's beyond the scope of Level 1. So we don't need to worry about that or get into that. Just worry at the first 3 parts of Schedule 8. All right, so just before the break, I'm sure everyone's head is spinning, but we'll just do this one before the break to see how comfy you are. And again, let's set the time to 1 minute. So what is the required CPP contribution then for a taxpayer with pensionable earnings of $70,000? Is it A, $3867.50, B, $3927.50, or C, $3956.75? Yeah, we never said there would be no math in this course, but bearing in mind what we've covered, I don't think this one's too tricky. Okay. All right. So a bit of a those of you who are able to figure it out. So the correct answer here is B. So first off, 70,000 is above 68,500. So we know the maximum contribution on the 68,500 already. So remember, 68,500 minus 3,500, 65,000. 5.95% of 65,000 is 3867.50, which means that this person has 1,500 in earnings, which are subject to CPP2 at 4%. 4% of 1,500 is $60. So B is 3867.50 plus that additional 4% on that additional 1,500, $60. So 3867 plus $60 gives us B, 3927.50. All right, good job. So, and I think most of you got B. C you would get if you had applied, I think, the 5.95%, the entire amount over 3,500. All right, I think, though, with that in mind, it is time for a break. So let us break for 15 minutes here. It is, let me see what time it is according to my machine. It is 11:45. Okay, so let's break till 12.
Okay, I shall pause the recording.
Thank you, Charles. I had to go pick up some. All right, but here we go. So, welcome back, everybody. Let's move my chat window over here. Distance window over there. And let's move on. So, now that we've talked about CPP, we're going to talk about the next stages in the T1 form. We're going to talk about step 5. Now, step 5 has 3 steps to it, but first to review, we should all remember step 1 of the form is identification information only. Steps 2, 3, and 4 about calculating income. So in step 1, we add together all our income for total income. In step 2, we make certain deductions to arrive at net income. And in step 3, we apply more deductions to arrive at taxable income. What comes next is we need to calculate the raw tax, federal tax, on that taxable income. So part A of the form is where we calculate the tax on the taxable income. Part B is where we calculate non-refundable tax credits that are going to cancel out a certain amount of that tax. And then in Part C, we arrive at net federal tax, where we compare the raw tax to the tax credit. And then this leaves us with a net amount. We also apply certain other non-standard tax credits show up in this stage as well. Okay. Now, the slides for the next section blow up certain portions of the form. I find, for myself as an instructor, I just like to walk you through the form because it gives a better sense of how things operate mechanically. So, let me pull up a basic, a blank form. And again, remember, you can find the forms. There we are. I want to fill the forms, level 1 English. There we go. Remember, you can also find these forms online. And remember that for provinces outside British Columbia, they use their own version of the form. Or if you're in Nova Scotia, New Brunswick, Alberta, Manitoba, Saskatchewan, you use the generic T5015. But for us here in BC, we use the 5010R. Now, one reason I like to work on the form is that it lets me blow it up a little bit. If my trackpad will, there we go, give us a nice view of it here. Okay, so this makes it a little easier to read. So let's scroll down a bit. So step 1 is for information purposes. Step 2, we calculate up all the total income. Step 3, again, we take the total income from the top of the previous page, move it down here to the top of step 3. We add together our deductions here, and then we deduct that amount here to give us our net income before adjustments. If there is any repayment for EI or OAS, it goes in here. After we deduct that, if any, then we are left with net income on line 23600. That carries forward to the top of the next page. Where we calculate taxable income. So taxable income, so net income goes up here. We add together any deductions for net income to give us our taxable income. So we deduct the deductions here, and then whatever's left over on line 26000 is our taxable income. All right. Assuming my chat window is working, someone please give me an amount for taxable income. Any amount. Let's keep it under $1 million just to save ourselves all those zeros. 45,000. Okay, thank you, Charles. All right, so what would happen here? So someone, after any deductions, is left with 45,000. All right, so what happens next is step A of part 5. We take this amount in taxable income and we drop it into this diagram down here. And we figure out how much the amount is, and we look at the instructions here. So we use the amount from line 2600 to complete the column below. Line 2600 is 55,867 or less. All right, so we just follow the instructions. So we take the 45,000, put it in here. All right, we subtract 0. So that leaves us with 45,000. I wonder what that subtraction is about. It will become clear, I'm sure. All right, what is 15% of 45,000? 6,750. All right, that seems reasonable. 6,750. All right. And again, we add 0. Interesting. I think wonder what that's about. All right, so we are left with $6,750. Okay, so that is the federal tax on taxable income. Well, that seems very straightforward. So think of this as the raw federal tax on $45,000 of income. Your raw federal tax would be $6,750. Notice the mechanical numbers down the side here. What might not be obvious is that you're only ever going to use one of these 5 columns. You're going to enter an amount in line 75, subtract the amount on line 76 to give you the amount on line 77. You'll multiply line 77 by the amount on line 78. That'll give you a result on line 79. You will add the amount on line 80. That gives you the amount in line 81. And then that moves forward to line 124. Line 124 is going to be further down the form. I'll just show you where that is. So in this case, 6750. Let's put it all the way down here on line 124. And just put it out of our mind for the moment. And there's no tax on split income here because this person is not a millionaire. So that's going to show up there, line 126. Okay, let's just leave that there for the moment. Now, your question you probably would have is, what about these other lines that are zeros? Where is that coming from? What's that all about? Well, to illustrate that, I would like someone to give me a different amount for taxable income. Let's assume the taxable income is not 45,000. Let's assume it's a higher amount. All right, so okay, 65,000 from Maria. Okay, Maria was first, so let's plug that in there. Okay, so let's assume it's 65,000. All right, so that 65,000 drops into the second column. All right, so we take our 65,000 and we subtract 55,867. Okay, so how much is that? 65,000 minus 55,867? Okay, 9,133. Okay, so 9,133. So what we multiply that by 20.5%. What is 20.5% of 9,133? 1872, 26 or 27? I suspect 27. Can you make sure I've got a decimal in there? So 1872.27 plus 83.8005. How much would that be? Exactly, Charles. 0.265 rounds up to 0.27. Okay, 1872.27 plus 83.8005, 10,252.32. Okay, good. So this is the federal tax on 65,000 in taxable income. Now, some of you may be wondering, okay, where is this line 76 coming from? What is this 55,867? What this should jump out at you is this is the amount from the first tax bracket. This is the maximum for the first tax bracket. So, to illustrate, if we take 55,867, that's the first tax bracket. We don't subtract anything. So this gives us 55,867. In other words, the entire 55,867 will be taxed at 15%. So in the second column, what's happening here is the amount which is already been taxed in the first bracket is deducted, giving us only the amount which is taxed at 20.5%. Exactly, Zona. These are the tax brackets for federal tax. 15% of 55,867 is 83.8005. So if someone had exactly 55,867 in federal income, they would have raw income tax of 83.8005, right? But rather than filling out that entire column, the way this diagram works is it already does the math on the first column. So this 83.8005 is just added here. And this income, which is already taxed down here, is subtracted here, giving us only the amount which is going to be taxed at 20.5%. You see? The entire diagram works that way. So if you had income over in the maximum tax bracket, over 246,752, you would subtract the first 246,752 because that has already been taxed in the lower tax brackets. You only calculate the amount that's going to be taxed at 33%. And then you add in the amount of tax you would have from the other four columns. And that is 57,143.93. Right? So the entire idea is you only ever have to do one column of the five. You're only ever calculating on the highest tax bracket. All right, all clear? Because all the math for all the other levels has already been done. Now, now let's assume, now that's tax, that's raw tax. What is a tax credit? Well, for our example here, where someone had taxable income of $65,000, all people who are residents of Canada for the entire year gets what's called a basic personal amount. And you can think of it as the amount of income they can make before they have to start paying tax. So if they're net income is less than 173,000 or so, then their first 15,705, they don't have to pay taxes on it. How does this work? So we enter 15,705 here. The rest of page 5 is for other what we call personal tax credits. They are credits related to people. In this case, this person we assume is single, so they're just claiming the credit for themselves. We will talk about all the other examples later in the course, don't you worry. That 15,705 transfers to the top of the next page, where additional tax credits, if any, can be claimed. If, for example, this person had employment income, they would claim what's called the Canada employment amount of $1,433. So that $1,433, we'll add this here for fun. So 1,433. So 15,705 plus 1,433 we would add in here. Okay, now for someone with 65,000 in taxable income, we could go through and calculate their CPP and EI. Obviously, don't want to do that right at this point, just in the interest of speed. But mechanically, you can see what's happening here. Certain tax credits, mainly relating to employment, are added together here, and they're brought over to line 102 and added to the 15,705. If we add that together, that would give us how much is 15,705 plus 1,433? $17,138. That sounds about right. Okay, so that's 17,138. You can see transfers down the page, 17,138. So mechanically, you can see that some of these other tax credits here are added in stages. The significance of that we're going to touch on later in the course. Some of the tax credits here have additional calculations associated with them. We will touch on that later in the course. But assuming that none of these more complex things come into play, we are left with 17,138 as the tax credit amount on line 33500, and then we multiply that by 15%. What is 15% of 17,138? 2570.7. That sound right, everybody? So there are no donations in this case. Donations are not calculated at a simple 15% is why they are added at the end. So that 2570.70 is the final result for tax credits. So you can think of this as 2570.70 in tax, which is going to be canceled out. Remember, 15% is the bottom federal tax bracket. So we can think of this as, this person's first 17,138, they don't have to pay taxes on. So 2570 in tax is canceled out. So the amount from line 123 here the amount from line 35000, this amount comes in down here. If there's a dividend tax credit, which we'll talk about later, that's added in. That final result then, the 2570.70. Missing a zero. 2570.70. Chosen there. So 6750 minus 2570.70. So remember, the 6750, that is the tax we calculated earlier on 65,000 in taxable income. So assuming someone had 65,000 in taxable income, they would have